Hi, I'm Kyle Peterty, VP Commercial Banking and Credit. Welcome to CFI's course on analyzing growth drivers and business risks. When assessing a company, understanding the factors that create opportunities and risks for that business is paramount. Whether you're a financial analyst, a management consultant, or an entrepreneur, there are many tools you can employ to better evaluate a company or a product's likelihood of ongoing success. By the end of this course, learners will be able to define key categories of growth drivers and business risks, compare different business analysis frameworks, define how economic, industry, and company-level characteristics may influence business strategies and outcomes, interpret the results of qualitative assessments, and explain how these results may inform financial analysis, including, in particular, model assumptions. Throughout this course, you'll be watching video lectures, participating in interactive exercises, and working through 2 example case studies to think critically about these concepts. At the end, you'll complete a qualified assessment to test what you've learned. This course is designed for beginner and intermediate business and finance enthusiasts in order to help connect theory to the real world. We have some great stuff to cover. Let's get started. For context, we're going to look at growth drivers and business risk throughout this course using the following framework. As we know, a business operates within an industry, and that industry fits into the broader economy. We'll start by assessing the external economy and the business environment and its potential impact on the business itself. We call this a top-down approach. Then we'll get into the industry and its impact on the business before finally looking at the company itself. By using this framework, we can be very structured and very specific in our approach to assessing growth drivers and business risks. Let's explore each of these in a little more detail. When it comes to assessing the external business environment, we're going to use a framework called pastel analysis, where we look at political, economic, social, technological, environmental, and legal impacts as far as the economy goes and the bigger picture impact on the business. Within the industry chapter, we're going to look at Porter's 5 forces, which shows the degree of industry rivalry and how attractive an industry is based on several key measures. Next, we'll look to better understand the concept of an industry life cycle, which will have a major impact on both growth prospects and on risk. The last section is at the company level, where we'll look to better understand competitive positioning and competitive advantage before unpacking Ansoff's matrix. Finally, we'll tie everything together by introducing a SWOT analysis where we look at the company's strengths, weaknesses, opportunities, and threats. By combining all 3 of these layers of the framework, we can assess the company's overall opportunities for growth, as well as what kinds of headwinds it might be facing. It could be that you have positive forces at one level and negative forces at another, so taking a comprehensive approach is very important. Once we understand all these different levels, we'll start to consider how they affect financial analysis, whether that's in support of management doing internal projections, equity researchers conducting valuations, or credit professionals assessing the creditworthiness of a prospective borrower. As a reminder, we'll start at the top here in the external business environment. A very popular assessment tool used to assess the environment in which a business operates is the pastel framework. Historically, it was called a PEST analysis, which stood for political, economic, social, and technological. Over time, the framework evolved to include environmental and legal factors too. It's used in corporate strategic planning to identify pros and cons of the company's potential strategic initiatives. Management may use the framework to both anticipate what they think is going to happen in the external business environment, as well as to react to what actually does unfold. Other types of banking and finance professionals will also use the framework to assess risks and opportunities, but in order to inform investment or lending decisions, as opposed to strategic growth initiatives, as management might. We'll go through each of these 6 factors independently, along with an example. Political factors can have a serious impact on industries and on individual businesses. These can range rather considerably, but include government policies that are fiscal in nature, like taxation and spending. These are typically driven by the legislative branches of government, as opposed to monetary policy, which we'll cover in economic factors. Corporate tax rates are a big consideration for management teams and analysts alike when it comes to political factors. More generally, government relations with the corporate world are also a big factor. These can influence the level of innovation-related initiatives and the nature of funding or grants that may be available. This is particularly true during election periods, which can be very unsettling for financial markets. The consensus view is that the political right tends to advocate policy initiatives that are more favorable towards the business community, while the left is considered by many to have a reputation of taxing and spending more heavily. Closely contested elections can really roil markets with all the uncertainty that accompanies them. Competition and general antitrust issues, including regulation around the extent and nature of patent protection, as well as the level of consolidation that can or should be permitted within industries, is also a concern of management teams everywhere. Views on competition and anti-competition often have political undercurrents and motivations. And finally, trade relations on a global scale more broadly. Consider the risks and opportunities that faced businesses during the renegotiation of NAFTA, the North American Free Trade Agreement, now called the USMCA, the United States-Mexico-Canada Agreement. It was an overhang in boardrooms across North America that created levels of trade-related uncertainty not seen in a generation. Economic factors tend to be easiest for the analyst community to conceptualize, as they're much more quantitative in nature. Unlike fiscal policies, which fall under the political bucket, monetary policy is a big driver of the economics section in a Pestel analysis. Monetary policy is administered typically by central banks, and it directly helps to control the money supply. Overnight lending rates are a lever used by central banks to help try and manage inflation. They influence bond yields and the cost of borrowing more broadly, which affects spending in the economy. Prevailing rates also have a direct impact on foreign exchange rates due to inflows and outflows of capital. Foreign exchange considerations are included in this section too. In the US, the sale of or the purchase of US Treasuries is another tool that's used to influence the money supply. When the central bank is purchasing treasuries, it's their way of injecting money into the economy, called quantitative easing. More money sloshing around the economy tends to increase spending on consumption as well as business investment, both of which can have a material impact on the business community and on GDP. Increased money supply for extended periods may cause the economy to run hot, though, which can cause inflation and, in turn, force the central bank to hike rates. For a more complete overview of how these financial indicators tie together, consider CFI's Economics for Capital Markets course. Where we are in the economic cycle, as well as employment rates, also fit into the economic factors section of a Pestel. Social factors can have a significant impact on business, on entire industries in fact. Consider things like consumer attitudes and values. For example, a trend towards healthier lifestyles has profoundly affected the types of foods that consumers want to eat, the nature of its packaging, and how nutritional information is presented, as well as greater transparency around where ingredients are sourced from. Demographic trends fit into this category too, and can similarly influence markets as we know them. Smaller average family sizes, coupled with massive migration towards urban centers, have resulted in big changes to the nature of real estate development in downtown cores, with mixed-use commercial and residential condo towers gaining enormous popularity. Consumer needs and desires for convenience and quality service are also big considerations. Think about the evolution of food delivery apps. Technology only tells part of the story here. In fact, consumers crave convenience, so platforms that permit convenient and seamless execution have opportunities to gain significant market share. Those that can't are likely to face serious headwinds. Technological considerations can be real game changers for a business, its industry, and for the broader economy. Some components are somewhat obvious and would have been included in more traditional pest or pestel analyses, like a firm's R&D spend, for instance. Where is it relative to its industry peer group? How does this innovation affect projections and margins? How intensive is R&D spend by a business's direct competitors? Increasingly, however, new technological considerations are emerging. Analysts find themselves asking questions about concepts that didn't even exist a few short years ago. A good example is, how might blockchain technology impact this business? Will the evolution of the metaverse serve as a disruptive force in the industry? And so on. Technological infrastructure, like the Internet of Things and 5G, are drivers of change in many industries that were once very traditional in nature too. The growing threat of cybersecurity attacks is another technological factor that keeps management teams up at night, especially in an age where so much of a consumer's life exists online. Automation, too, can present enormous changes for businesses and industries. It can drastically improve margins by eliminating headcount, but it can also be devastating for communities and for the broader economy if it results in massive layoffs and unemployment. The environmental section of the Pastel analysis is a newer addition, but one that is very important in today's ESG-centric business climate. Factors include resiliency to climate change impacts, both physical risks like flooding, as well as transitional risks like changing stakeholder expectations. What, if any, are the ecological impacts of a business or an industry? Things like stewardship of natural resources, like fresh water, as well as a firm's actual carbon footprint, the clear disclosure and management of which are increasingly becoming a focus of management teams and boards. The best analysts and management teams look beyond just the business or the immediate industry. Their analysis extends up and down the supply chain too. Perhaps a firm's main operations are somewhere relatively sheltered from physical climate risks. But what about its suppliers in developing economies? Are there environmental risks there that could turn into business risks here? The evolution of ESG as an overall assessment framework has really changed the way that operators and analysts look at sustainability. It's forced a much more comprehensive process. CFI has a number of ESG courses designed for the analyst community, including our free Introduction to ESG course, which you can check out below. Legal factors are risks and opportunities that may change the way businesses operate. Consider how evolving labor standards, both domestically and abroad, might materially impact margins. Extensive licensing and permitting requirements may be looked at differently depending on your perspective. A prospective new entrant may see them as a barrier to entry, while an incumbent might appreciate the red tape and consider it a protective moat. For public companies, changes to reporting requirements by stock markets could fall into this category. So too can the ever-evolving landscape of ESG disclosure requirements by governments and stock markets. Intellectual property issues and the right to profits should be considered as well. Think about the rush to create a COVID vaccine after the pandemic hit in 2020. Government agencies globally put up billions of dollars in funding to streamline testing and approval processes, while private enterprise, biotechs, and the like ultimately captured profits from the commercialization of these drugs. Who owns that IP? There could be legal overhangs and pending lawsuits for many years as stakeholders sort through this question and others like it. As an analyst, we need to understand how these factors may impact individual businesses as well as the industries in which they operate. Let's tie it together and do a quick Pastel analysis for a supermarket business or a grocery store. Maybe we can assume it's a small regional chain. We'll start with political. We need to look at trade policies and how they might impact the import of produce, as well as meat and dairy products. These are, of course, inventory that the grocery chain is going to carry, and are also frequently the subject of tariffs and other trade disputes. Are there maybe government grants available to support employment that might help defer some labor costs? In the same vein, are there tax incentives available that haven't been explored yet by management? Then we can consider economic factors such as household incomes, transportation costs, interest rates, and inflation. All of these, again, should inform the strategy of the company. Does it want to carry low-cost foods or premium higher-cost foods? Disposable incomes are really going to impact that. Assuming we're in an inflationary environment, does the current economic picture permit cost increases to inventory and transportation to be passed along to consumers? Next are social factors. Consider demographic trends like smaller families and smaller homes, maybe more urban townhomes and condos. Fewer people have chest freezers or large pantries to store dry goods. So, does this potentially change consumer habits and require them to shop more frequently at a lower average ticket price? Do store footprints align with this evolution? And what about health trends? Will the chain be required to change some of the products it offers or some of its suppliers to meet evolving consumer demands? Then there are technological trends. There is a subset of people that rarely even go to a grocery store anymore. They use food delivery services. Maybe that's meal prep kits, or perhaps it's third-party grocery delivery apps. Will this create risks or opportunities for this chain? What about inventory management software? Are they keeping up and optimizing their turns? Do they have a mobile-based rewards app to engage consumers? If not, could they? If yes, what are they doing to keep customer data protected? Technology is changing industries so much and so frequently that it's important to stay on top of this. Moving on to environmental, supermarkets actually have really high carbon footprints. They're big users of purchased electricity, a Scope 2 emission. They also, if not careful, can waste extraordinary amounts of food that's past expiry or no longer saleable. This can represent both a financial and a reputational risk. And what about susceptibility to extreme weather events up the supply chain? Could flooding or drought have material impacts to its agricultural suppliers? What, if anything, are they doing to mitigate these risks? Consider asking if operators are embracing this and trying to improve processes and overall transparency around environmental impacts. And then finally, legal factors. For example, consumer safety policies that could impact the way the business operates or the way it trains its staff. Is the industry looking at more regulation or less? It's rare to see deregulation in the food business or around labor standards. These can have significant impacts on operators in this industry. So, if you're an analyst, you may be asking management about their growth strategies. You're going to want to understand if the firm's plans work within the context of these pestle findings. Always be asking if the trends you're identifying will serve as tailwinds or as headwinds to a business that you're covering.